Thank you for joining us. My name is Zach Wilson. I'm an IRA specialist here at Quest Trust Company. So before we get started, got to give you the disclaimer. Everything that you're about to see here is for your educational purposes only, right? At Quest, we like to provide as much information and as much education as we can to both our clients and investors. It's important to recognize the role that Quest will play in your investments, right? We're here to answer any questions that you might have. We're here to facilitate all of the transactions that you request. But that being said, Quest does not offer any tax, legal, or investment advice. Now, for those of you who don't know us, a little bit about Quest. We are the largest self-directed IRA custodian in the state of Texas. We have about 20,000 active investor clients all across the country. Right now, we have over $2 billion in assets under administration. We have over 100. Check out our website. Be sure to take advantage of all the opportunities that we have to answer any of the questions that you might have regarding your investments, right? We have hundreds and hundreds of videos going over everything from the basics of a self-directed IRA all the way to the ins and outs of a syndication and what that looks like within your IRA, all right? Now, once you're comfortable with the investment that you're looking to pursue, well, the deal's not going to find itself, right? So the next step is going to be the networking, right? Take advantage of all the networking opportunities that we give you guys. We have weekly classes like this one today on Tuesdays. We have our self-directed IRA Saturdays at noon on Saturday. We also have our virtual happy hour on the fourth Wednesday of every month starting at 6:30. Now that one is strictly meant for networking so that you can build relationships with the potential investors that can make your deals happen. But by far, our most popular networking event is going to be our self-directed IRA socials on the first, second, and third Tuesday of every month in Houston, Austin, and Dallas, respectively. Now, that starts at 6:30. Usually starts off 30 minutes of networking. We give a presentation. You get to network again after the presentation. And then we also are bringing back deal pitching. So guys, if you have active deals that you're looking to make, this is where you're going to take advantage of them. All right. Now we have one today, in fact, in Austin, and we have Paul Leonardo's coming out with Blink Lending. So that's going to be an excellent one to attend for sure. But biggest event we have, guys, is going to be our Quest Expo. Right. This is where the culmination of everything that we can offer you as a company. This is where it's going to be. Right. It's going to be in September 23rd to 25th here in Houston. And what we're going to have is about 30 speakers coming out. We're going to go over private money lending within your IRA. We're going to look at syndications. We're going to look even at inflation and the role that alternative assets can play within your IRA to help mitigate any sort of risk dealing with that inflation. All right, guys. Now, like I said, this is a must-attend event. Right now, we're running an early bird special that if you purchase your ticket now, you get early bird pricing. And if you reach out to me with the code up top, I can actually get you an additional discount. That means we're looking at a $250 value for over 40% off if we use this code. Guys, please give us a call. Please ask us. Really, all you're doing by delaying is just increasing the amount that you're going to have to pay for this ticket. As I promise you, you're going to walk away with more information than you have before. This is going to be, without a doubt, our must-attend event. So with that being said, if you've got any questions at all, reach out to me. I'd be happy to help you. Reach out to any of the IRA specialists. We all have a code that we can give you to make sure you're taking advantage of that additional time, or I'm sorry, that additional discount that you have. All right, guys. So that's it for me. Without further ado, let me bring on our guest speaker here, Paolo Ruggieri. Paolo, are you there?
Yes, I'm here. Can you hear me?
Yes, sir. Yes, we can. All right, welcome, welcome. So that's going to be it for me, guys. I'm going to give Paolo the floor now.
Guys, thank you so much for coming and attending. And I prepared an overview of 5 different ways you can invest in real estate. One of the 5 that are the most common. After all of there are going to be a lot more that you could do. I also created at the end of this presentation a spot to discuss inflation and see how inflation can impact some of these ways to invest. Really, the idea here is for you to be able to have a general overview and having a 50,000 feet view of different options that you might have that you might not be aware of. So what we're going to do is we're going to look at fix and flip, turnkey rentals, BRRRR strategy. BRRRR stands for buy, rehab, rent, refinance, and repeat. And wholesaling and or invest passively in a fund or in a REIT. For each one of them, as you're looking to invest, you probably want to know what type of effort you're going to have to put into. What are the risks? What are some of the risk mitigation that you can put in place in order to address these risks? What are the short-term returns that you can expect? What are the long-term returns? Hopefully this will be a matrix that will help you tremendously to make a decision where to deep dive. So fix and flip. Fix and flip is when you purchase a distressed property that maybe might be worth $100K for only 40 cents on a dollar. You put 40 into it, and you have a gross profit of 20 by reselling it for 100. So with this one, your effort is going to be high. You're going to have to deal with finding the property, underwriting the property, doing the rehabs, dealing with this unknowns of the rehabs, and dealing with deciding what rehabs to do and how to maximize price. The short-term return are definitely great if you know what you're doing. And there is no long-term return on the fix and flip, as once it's sold, the deal is totally done. So this does not create passive income. As far as the risk, from my observation after having seen hundreds, if not thousands of transactions, it really goes with the know-how. The more you know what you're doing, how to read a deal, how to decide which rehabs to do, how to decide what finishes to do, how to decide what is the right price, or how to deal with contractors, the less risk you're going to have. So, the first deals are usually the highest risk. And so my suggestion here is you can partner with an experienced person that might not have your credit or liquidity. You can work with a mentor. Make sure that you do a lot of digging and referrals on the mentors, as they're really good mentors, but are also not as good mentors. Or you can become a wholesaler, which is going to be the fourth down that you see in the presentation, which is a very low risk option and really get your feet wet into the fix and flips. Let's look at the second one, where probably many of you are looking to do. Turnkey rentals. You're really going in for a property that's worth 100 after some digging, or because you have cash on hand and you can close fast, you can buy slightly under market. On this one, what I mean for turnkey is property has been already fixed. The effort initially is medium, as you need to go and look for properties, etc. Then it'll become low. You have still some risks. On the short term, you have liquidity. Despite the best effort in investigating the property, you can run into having evictions, wrong markets. You can have delayed maintenance that you couldn't catch before. So initially, you might have to spend more money that you didn't project, and the market could turn down. But both of them are temporarily. So you want to ensure that you have cash reserves and that you buy with a long-term view. Again, the short-term returns initially are not very many, but eventually, as your rent increases and your mortgage payment remains the same, you'll get over time a positive cash flow. And as time passes by, the property value will appreciate, while your mortgage balance will go down, increasing equity. So both cash flow and equity creation are really long-term. It's a long-term gain. There are some costs associated in doing transactions and figuring things out. So this is really a good method for low effort in the long term and value creation in the long term. The broader strategy means, again, you buy a property, you rehab it, you rent it, you refinance it, and you do it again. This is how I personally built real estate portfolio of over 30 rental dwellings before starting hard money lending. The effort, so in this case, is you buy the same property for 40 as in fix and flip. You put 30 into it, not 40 as you need a lower level of renovations. You will still have a good margin. And most of all, you have a lower mortgage payment as you spend less money into it. The effort is medium. It will never get low as you're constantly repeating this system. You definitely have a mix of the two risks above, of short-term liquidity and know-how, even though some mistakes are more forgiving. If you didn't do the right finishes, you still can rent it. If you have not budgeted everything possible, you're still okay because you got a good refinancing option. Definitely the best thing to do for mitigating these risks are still having cash reserves. And in a lot of education is this strategy requires a combination of different skill sets. You get a short-term return, not as much as the fix and flip because you're not trying to maximize it, but the long-term return is very good. It is an enormous one because what you're doing is, again, if I look at my experience, I rotate the same money over and over and over and build, and build one property after another, recuperating every time I would refinance. I would recuperate the initial capital and was able to do tens of properties. Then you have wholesaling. Wholesaling is very little risk and a lot of hustling. You basically go in the market, look at a lot of different opportunities, make a lot of offers, and try to really buy the property below what a typical investor would buy for. And you're just reselling it, or you're reselling, it's called an assignment, the contract, right away without any rehabbing. With this, it's often you can do a double close and close on the same day you're buying the property. You can make a small profit and then start it all over again. With this, again, the effort is extremely high as you are needing to hustle to beat the competition and actually having a price is so low there's margin for you and an investor. The risk is definitely the time because it's very consuming. And the risk mitigation is really to have systems for efficiency. There's if you reach out to me, there are several softwares and tools, etc. I could suggest, but they all cost money. Another option is just literally spending your own time to look through public records, look for distressed seller, or just making a lot of offers. Short-term return is decent, even though it's never going to be as much as the fix and flip. And really the long-term benefit here is experience. Once you learn how to flip a deal, you learn a lot of how other people are going to look at the deal. And you need to see which deal sells and which deal doesn't sell and why. And that really is a very valuable asset for you then to move to other pieces in this area. Then there is passive investment, where you trust people that have funds or REITs. Obviously, the effort in theory is null. You're really putting a lot of trust on the principle of this operation. So how are they doing? What do they know? Do they know what they're doing? You need to really vet the people. Don't be scared of asking a lot of questions. And if you don't get answers that you understand, move on to another offer. Really, the risk mitigation is, again, you go through a lot of questions and also ask referrals from people that have worked with them before. Short-term and long-term really will depend on the philosophy of investment or the fund or the REIT. So before I go through the second part of the presentation, which has to do with inflation, I would like to take a pause and see what questions might have come up.
Hey, Paolo, thank you. So looks like right now right now, no, we haven't got any questions so far. But if you just want to keep going, what we'll do is we'll gather the questions that come in. And guys, please take advantage of the chat. There's tons of opportunity. Both, I mean, I'm sure any questions that you have, I know other people will have as well. So go ahead and throw them in the chat. If they're IRA questions, we'll be happy to address them. If they're questions for Paolo, then we'll go ahead and address them after this. Okay.
Yes. So again, one more minute on this chart. Really, the intent of this presentation is really to give you an overview and hopefully get several questions from you guys in order for me to be able to go deeper on any of the subjects that are here on the slide. I want to give a presentation on inflation and talk more about how inflation works and what does it mean for you. So in general, in the market, you have two prices. You have a purchase price and a rental price, and inflation should impact both of them in theory. So if we have a sales price index right now for 8%, it should go, in theory, you expect both the value of a home and the rentals to go up 8%. In reality, due to the increased mortgage payments that people need to make with a higher interest rate, they will be able to afford lesser of a house because their payment is going to have more interest and therefore less principal. And therefore, with a weaker demand on house purchases, the prices will still increase, but less than the inflation. Because since people need a place to stay, obviously there is an additional element of new construction, but to simplify, is people need a place to stay. They will need now to go and fund a rental if they can't afford a mortgage for what they want from a house, or they can't qualify for the mortgage due to the debt to income ratio. So in this case, you will have a demand that has to move away from purchasing a house to renting it, making a demand of rentals higher, and go with the rentals going through much higher than inflation. This is exactly what is happening in several markets. So the cap rate, which is the ratio between rent and value, will go up, making a change and an impact on different categories that we have discussed so far. Any questions on this theory before I deep dive on how does inflation impact the different ways to invest in real estate?
So no questions specifically on inflation right now. We did have a question, though, regarding your earlier presentation. It's asking, what about the ability to exit the fund / REIT? What is the typical hold period?
Okay, well, that's a great question. So you will have typically three funds. Obviously, every fund is different, but I would probably categorize it in three. You have one with longer-term strategies that are typically 5 years, where you are committed for a long term, where the fund will make long-term value-add investments. For example, if they invest in commercial, or they build, which could be typical examples, could be building medical facilities in an area that has a need. It will take you two to 3 years for the constructions, the approval, and the permitting, and then you will have to find all the medical facilities to rent it. And therefore, the project will take several years. So this is one of the many examples of what REIT or funds can do. Many others might have investments that have a bit of a shorter term, but they insure, for example, on the turnkey rentals. They might have a lot of turnkey rentals, so they insure, as mentioned at the beginning, that might not be they might not become cash positive for a period, and there are transactional costs in order to buy and then resell a property. So if they might go for a 5-year term. So that's one where they have a very defined long-term strategy of something that they need to develop and show the ability of cash flowing. You will have another one that is more of a generic type of investment that might do some bridge deals like the fix and flip, which would have a rotating capital. And typically what I've seen with them is that you have a vesting period, typically of 12 months. And then after 12 months, you can withdraw your money. And what they have is they will have multiple properties at different stages. They're rotating, but they want to count on the capital for at least a year in order to ensure that they don't have all of a sudden everyone taking money out. Then you could have a third one, which is typically in the space where I work with, which is short-term lending, where we have a very high velocity of capital by lending and then resell debt into the capital markets, where money can rotate in 1, 2, or 3 weeks. So at that point, for those type of funds, the rotation, it can be as fast as asking your money back in 3 or 4 weeks, or even less. So definitely, I do agree. Looking at a fund, you definitely, this is part of the reason why there is this errors. You also want to look at the redemption period. Now, I didn't mention it as this was more of a IRA and retirement accounts type of presentation, where typically that is not a need of an investor, but yes, this is kind of my 3 main categories. So long story short, it really depends on the investment strategy of the fund, but they usually come in those 3 categories that I mentioned.
Awesome. Awesome. Thank you so much. So we got another one here.
Sorry about this. This is okay. Go ahead.
That's all right. So we have another question here from Corey Harder. It says, what are your thoughts on financing for a fix and flip or the BRRRR method? Traditional, commercial, hard money, etc.
Okay. So for the fix and flip, the main you're going to have multiple strategies. So your first strategy for financing is if you can avoid having to finance for the property. So if you have really good credit and you can refinance your house, or many times you can have a HELOC on your own home, this is going to be usually the cheapest method. Often that if you have good credit, you can also get unsecured credit, which means it's basically a personal loan. What this typically does is it allows you, depending on your income, it allows you definitely to get down payment money, or sometimes the vast majority of the project. The second method is to go through hard money or soft money. So there are different type of lenders. There are lenders that go with speed, and other lenders that go with rates. Typically, people that go with speed will allow you to close in 3 to 5 days, and therefore capture the best deals. People that go with rate will typically take 3 to 4 weeks, which in this market, it's often just too long. In both products, you need to expect, if you're a newbie, to probably put down around 20 to 15%, 15 to 20% of the total cost between purchase and rehab. If you're an experienced investor, it can be 15 to 10% or less. These percentages are slightly changing as inflation goes up, and there are more questions on the valuation of properties 6 to 12 months down the road. As far as the BRRRR strategy, when you purchase the property, is going to be very similar to what I mentioned on the fix and flip. When you're trying to refinance on a permanent loan, if it is in your personal name and you can fit in a Fannie Mae or Freddie Mac that rule, those typically the best long-term rates. If not, you can typically cash out at 75% loan to value after 6 months that you own the property. And there are several products that can let you do that. The market used to have around 4 to 5% rates for those, and now we're probably around 7s, given the recent inflation. So with the bridge strategy, you really are going to have an initial financing as a bridge and then a long-term financing. If you have a retirement account and you want to use your retirement account, you still can get financing for these. It probably will just be a lower leverage, as you cannot sign a personal guarantee for something that is owned by your retirement.
Yeah, exactly. And guys, always keep in mind that, yeah, like Paolo said, your IRA can absolutely take out a loan whenever doing these fix and flips. You just got to be sure that it's containing what's called non-recourse language. All right, it's just got to be a non-recourse loan. That's what the IRA can accept. And for more information on that, give us a call, ask to speak to an IRA specialist. We can take a deeper dive into that. So thank you, Paolo. We have one more question. And then Julio, I see your question, and I'll go ahead and address that in the chat since that one's more geared to IRAs. The question here for you, Paolo, is what are the minimum investment amounts for these funds?
They vary. They definitely vary. Usually, I would say they are 20K, 30K, 40K, on up to 100K plus. Now, there are some funds that just try to get a relationship with you. They go as little as 5 or 10K, where the fund itself might have an administration cost that outweighs the benefit of accepting your low investment, but they do it for establishing a relationship.
Awesome. Well, so that's gonna be all the questions so far. If you want to jump into the inflation part of the presentation, and guys, sure, like I said, just take advantage of the chat again. Throw any questions you have out there, and at the end of this, we'll go ahead and do another Q&A session.
Perfect. So we discussed the inflation, and let's look for fix and flip. So for fix and flip, definitely there is a decreased appreciation speed, which basically means that when inflation goes higher, the mortgage payments are higher, and therefore the affordability of the house is compromised, and therefore prices will not go up as much as they have so far. There will be, therefore, also longer days on the market, which means it will take longer as the demand cools off. You will have the property stay longer on the market and will have more days before it sells. And there will be increased cost of capital. People like me, as I land, will increase rates to you. So for fix and flip, inflation is not necessarily a good news. For Turnkey rentals, on the short term, it's kind of a wash. You're going to have higher rents, but also higher mortgage rates. On the long term, you can take advantage of the higher rents, and eventually, as the rates go back down, you can refinance. In the long term, it can be a positive. As far as the bridge strategy, it really takes, in this case, the maximum advantage, as you will have the rent increases. And you will go through in the bridge strategy with multiple refinances. So they are typically the ones that will, in strategy, that will gain the most, in my opinion, from inflation. Wholesaling is really unaffected. It's really about arbitration, and it's such a short term with double close on the same day that it is not really affected by inflation. And then the fund, you want to ensure that it really depends on the fund. I would say, again, that funds that are like mine or in my business, they're short-term lending. They can mitigate inflation by just increasing prices. And then ones that are rent basis, again, they can mitigate through rent increases. And as mentioned before, rents actually have a positive as they go up higher than inflation. On the other funds and REITs that have long-term commercial contracts or they do value add through bridge businesses instead will be affected as the economics in the economy can be affected with this. The demand for commercial can definitely be affected on a recession environments where some things are more optional for commercial. And on a value add bridge business, that goes back to what you see here on fix and flip, where they have all those three disadvantages. So this is my view on inflation for this strategies. I would like to add my own opinion that if I look at the inflation is happening, in my opinion, it's incidental, it's not systemic. We have oil prices going up, partially connected with the war in Ukraine. We have supply chain disruption that has happened. Some of you might know that China is still extreme COVID restrictions and also other parts of the world. And then we know that we have had the stimulus and all the government pumping money in the economy. And so all these three things are really not systemic of a world economy, but are three things that have happened and they have piled up one on each other for inflation. The recent announcements of the Fed of going up 25 and then 50 basis points of rate increases should cool off the economy. And some of these things should naturally resolve. Definitely there's not going to be any more stimulus. Hopefully COVID effect will be lower and lower. And maybe we really don't know about the war in Ukraine, but eventually oil prices will find a way to rebalance. So I believe that while we can think of inflation, I don't see this go too much beyond 6 to 12 months from now. What other questions would you have?
All right, guys. So there are all your questions in there. Anything for Paolo if you'd like to address? Right now, we don't have any. Let's see what we got here. Yeah, we've addressed everything in there.
Okay, well, maybe you can give out, if it's allowed, you can give out them my phone number in case people do have questions afterwards that they would like to go through more in depth that we didn't have a chance to ask during this presentation. And definitely if I'm about it again, I'll try then to have a wider content.
Absolutely, yeah. So, guys, you see Paolo's phone number on there. If you've got questions that come up after this, I know it always seems to be after everything's done that the questions really start coming up. Give him a call. He'd be happy to help you out. If you've got more IRA specific questions, give us a call. We'll be happy to kind of bridge the gap between Paolo and your IRA just to see how you can make these deals happen. But in the meantime, guys, that's it. Thank you guys for joining us. Paolo, thank you for coming out.
Thank you. Thank you. Have a great day. Bye-bye.
Oh, it looks like we got one more before I get
great.
to. Let's see. It says, how do you plan for the inflation and the strategy that you provided?
Well, this is, again, I mean, personally, well, I gave you kind of my own, idea with this slide on the different, the different strategies. But specifically in my business, maybe the question is more on my business then. What I am doing is in order to maybe answer the question, I might need to explain a little more about my business. In my business, what I do is I provide very fast financing so that people can get the best deal quickly, and I'm basically almost as good as cash. I can then demand high rates in order to provide this service. And then what I do is I take all these mortgage notes and I resell them within 2 to 4 weeks into the capital market. So I have investment banks that will pay a premium for the notes I have, as they have high quality, high grade notes with very good interest rates. So in my case, specifically, how do I plan is I ensure number one, that I increase my rates as matching inflation. Number two, I'm trying to be extremely careful on the valuation of the properties, and I'm going to lend either very conservatively on ratios and leverage, or I go into areas that are highly gentrifying. There's a big movement throughout the country where people are going back to urban areas, and as they're going back to urban areas, there are pockets of urban areas that used to be high crime areas that are completely regentrifying. In those areas, there are microeconomics of real estate in those areas where there's an excess of demand as there is scarce supply for this type of homes. So for those areas, I try to really invest in areas like this, where due to the gentrification and several things are happening in that specific city, in the specific pocket, prices are still going up 30 to 40% a year. And they should in the foreseeable future due to the local investments and the time that it takes for properties to go up in value. But and then I stay in extreme touch with Wall Street, and in a close touch with Wall Street, trying to understand what the 10-year Treasury is doing, and ensure that I can always look 2, 3, 4 weeks ahead of time of what's going to affect the capital markets that are going to buy my notes. Now, in my specific business, I'm highly privileged because it's such a short term that it's very difficult for something to completely collapse in real estate in 2 to 3 weeks. If you look at the recession, values went down 35% in 5 years. That means that it's been an average of 7% a year. There's been no year going down more than 10%, almost in any area. Therefore, if you're looking at short-term investments, the likelihood of going down and losing value with real estate that is not as volatile as other markets is pretty low. And if you, in my specific business, if you land at 75% or better on the value of the property, you're still fairly safe as you have the 25% remaining. Hopefully this answers the question if it was directly specific to me. If it was, again, if it was specific to the opportunities, this is kind of where I see the consequence. I don't know that on fix and flip you can prepare specifically for inflation. Again, probably one could be to go in a highly gentrifying area, as I was mentioning. Turnkey rentals, there's nothing you can do with inflation, but again, it could be a positive. The better strategy can be a positive as well. And again, the fund, kind of what I mentioned before, you need to look at funds that have either very short-term flipping strategies of flipping notes, or very short-term strategies, or that are rent-based.
Okay, awesome. So we got some more questions that all came in. I'm going to go to the next one. And it says, out of the 5 strategies that you mentioned, what is the best place for a beginner to start?
Okay, it depends. It depends on the amount of money you have. I would say if you're attending this call, probably you have a decent nest egg. So I would say that probably the best way to start can be either the turnkey rentals, as they have a moderate risk. Even if you do something wrong, they're not going to affect you tremendously. And then the fund and the REIT, trying to really understand by talking with people like me or several other people that have in an investment fund, trying to understand the strategy, trying to network with them, trying to understand how they do things, try to find, it would just be a really good way just to have this conversation for you to learn more about the market and enjoy and try and understand what you're more interested on. So you can kind of use us in order to decide what best fits for you. Now, if you have less money or you don't want to invest money, then definitely wholesaling is the way to start, because it will only get to your time. But again, I believe if you're attending these conferences because you have some funds available to invest. So I would go with turnkey rentals and founder rate, the two easiest to start with.
Awesome. Awesome. So we have another question from Thomas. It's asking, are there any tools that help you analyze the properties worth pursuing for the BRRRR strategy?
Absolutely. So what I would say is go with purchase price plus rehab should be no more than 80 times the rent. That's if you can fit the deal in that equation, that's what you need. So maybe if it's okay, I'll share an Excel. Can you guys see my Excel?
Yep.
So if you have a repair, purchase, so if you have a rent 1,500, you want to do rent times 80. And if you have $20,000 of repair, your purchase would be 100. It's a very simplified example. Now, this is kind of the ideal, and it might not be something that you can start with, as at the beginning, it is difficult for you to be able to find deals that equal that math. But that's what I used in order to grow my portfolio, because then if you look at the interest rate and the payment that you would pay on a 120, it would be approximately, it would have approximately 1,000 with the current interest rate. You would approximately pay 1,000 for a mortgage for 120 loan, and therefore you can make it with your rent and your space for property taxes, insurance, and other expenses, and over time you gain equity. So once again, I would say I'll write it right here: purchase price plus rehabs. It'll be less than rent times 80. Now, obviously, if you see these numbers are quite a bit challenging in this market. So one way is, again, you could start being a wholesaler in order to see how you get such good deals, or you could start maybe on your first deal to accept this being 100. So by this being 150,000, or maybe initially, if you have a rent for 1,500 and a mortgage for 1,250, you might not have enough space for everything that you need to pay between property management, repairs, property taxes, etc. But over time, obviously, the rent will increase, and therefore you just have a short term of negative cash flow. I definitely wouldn't go beyond 100. I would say 80 would be the ideal in order to start with a neutral cash flow rather than a negative cash flow. If you go to 100, which is maybe more market right now, you need to accept to have a negative cash flow at the beginning. The other thing you want to be careful of for newbies is that your mortgage payment, even if it looks like it's less than rent, in reality, your cash flow will again have other costs that are not mortgage only.
Awesome. Awesome. Thank you for that, Paolo. Okay, so next one is that are the turnkey rentals for multifamily, single family, or vacation rentals?
That's a great question. So they can be for all of the above. They can be for all of the above. If you go, on the single family, you are going to have an advantage where the market can go because of you have two type of valuation for single family, because you're going to have a single family people that buy it for investing it, or people that are going to buy for living. So depending on what's happening in the market, you can have two opportunities for these properties to increase in value. On a multifamily, the value of a multifamily is really tied to the income that the multifamily would generate, which is only as one. So even if the area goes up significantly in desirability, but not necessarily for rentals, the multifamily will have a value that might not increase as much as a single family. So with this, I would say that if you go to a multifamily, you probably would like to demand a better cap rate, so a better ratio than a single family when you buy it. So again, with the same type of rent ratio over value of the property, a single family is going to be better. But if you have multifamily and it has a better ratio, it would be okay as well. Vacation rentals have gone through a significant value increase due to COVID. The demand for these rentals has significantly expanded. People obviously now are going to work remote in a way that they were not working before COVID remotely. The market has adjusted, so the prices went up significantly, and new construction and new development has gone up significantly. So, and meanwhile, there's been a lot of lobbying from hotels and other lodging institutions against VRBOs and Airbnbs, as they are not required to have the same safety standards, where there is a high legislative risk. So I would suggest right now to stay away from vacation rentals.
Okay. Awesome. Thank you. So last question we have for you is asking if you are a hard money lender only.
Yeah, so I am a hard money lender. Yes, you could consider me a hard money lender. The difference is I also work with capital markets. While many other hard money lenders, they will just hold all their loans on their balance sheet. I find it a lot less risky to take the loans to resell them.
Awesome. Perfect. So that's it for the questions that we have, Paolo. They're asking if they can get an email to contact you or just your general contact information.
Absolutely. What I'll do here is, let me put it on the screen. It's Paolo at bpfastlending.com. You can hopefully see here on the screen. Again, it's Paolo at bpfastlending.com.
Awesome. And what was the number to reach you at?
The number is 404-782-1545. And again, I'm putting it here. Maybe you can write it on the chat as well for everybody. Or if you can email all the entities. I'm here to help. Any type of help you might need, I'll be happy to guide you.
Perfect. Yeah, I went ahead and threw it in the chat for everybody. There we go. 2:15. All right, everybody. So Paolo's information is in the chat. Feel free to reach out to him if you have questions, opportunities, if you're looking to borrow. I know Paolo will be able to help you and answer any questions that you might have. Again, if you've got more IRA-specific questions, give us a call here at Quest. Ask to speak to an IRA specialist, and we'll be able to help you out. But with that being said, Paolo, thank you so much for joining us. It was really informative. And so that's it. That's it. I hope you have a good day, Paolo.
Thank you, Zach. Thank you. Have a great day.
Yeah, so thank you. And thank you guys for joining us.
Thank you. Bye-bye.